Business Loan Denial Strategy Report. You approach a denial as a solvable legal and financial problem. You gather facts, identify which underwriting criteria you failed to meet, and correct those inputs with documentary evidence. You use federal credit rights, quantitative benchmarks, and lender-specific policies to convert a negative decision into an approval without guessing or reapplying prematurely. Footnote. This section frames denial as a fact-finding and remediation exercise guided by law and underwriting science. Read and analyze the denial notice. You begin with the adverse action notice that lenders must provide under federal law. You read the stated reasons and request the specific credit score data and key factors if they are not included. You document any factual errors, such as misreported balances or mistaken delinquencies, and you dispute them with the reporting bureaus while asking the lender to reconsider after correction. You preserve all correspondence and create a file you can append to a renewed application. Footnote. This section directs you to use statutory notice rights to isolate and correct the exact grounds for denial. Address leverage and repayment metrics. You reduce risk signals that dominate credit decisions. You target a debt-to-income ratio near 30 to 35% by paying down revolving balances or consolidating obligations. You raise the debt service coverage ratio to at least 1.25 by increasing recurring gross margin, extending maturities, or lowering fixed charges. You memorialize these changes with updated statements and a simple pro forma showing that scheduled payments are comfortably covered by operating cash. Footnote. This section instructs you to improve DTI and DSCR until repayment capacity is plainly evident. Remediate weak personal or business credit. You strengthen the file that will actually be scored. You separate business activity in a business credit profile, add vendor trade lines that report, and avoid inquiries until your score stabilizes. If personal credit remains a constraint, you prefer structures that rely on business credit, collateral, or verifiable revenues. Where available, you use asset-based financing or secured lines that look to equipment, receivables, or deposits rather than to a thin score. Footnote. This section shows you how to shift the underwriting focus from weak personal credit to stronger business or collateral signals. Match your profile to lender eligibility. You pre-screen lenders for minimum time in business, minimum annual revenue, minimum credit score, and collateral posture. You do not apply where you are materially outside the published bands. If collateral is the obstacle, you select unsecured products or revenue-backed offers that accept your profile. You record each lender's criteria and tailor your submission package so that every checklist item is satisfied before you press submit. Footnote. This section requires you to align your facts with stated eligibility so you do not trigger predictable denials. Demonstrate sufficient cash flow. You present a 12-month cash flow with bank statements that track deposits to sales and reconcile seasonality. You cut discretionary outflows, renegotiate payment terms, and show the surplus that remains after payroll, rent, taxes, and the proposed payment. Many lenders look for annual revenue of at least $100,000 to $250,000, so you confirm you meet the target or you select a product with lower thresholds. Footnote. This section teaches you to evidence reliable cash generation that safely covers the new obligation. Open and use a business checking account. You operate all revenues and expenses through a dedicated business checking account. You avoid cash-only patterns and commingling with personal activity. You provide 6 to 12 months of statements that corroborate your financials and stabilize daily balances, which reduces perceived volatility during underwriting. Footnote. This section emphasizes that clean banking data is often a gating item for approval. Account for industry risk. You verify whether your industry is excluded or risk-tiered by the lender. If your sector is viewed as volatile, you target lenders that specialize in your vertical or accept higher variability. You prepare a short risk memo that addresses licensing, compliance, seasonality, and customer concentration so the underwriter sees concrete mitigants rather than unsupported optimism. Footnote. This section advises you to confront industry risk directly and choose receptive counterparties. Submit a persuasive business plan. You file a concise plan that states the model, the market, the unit economics, and the operational milestones. You include 3 statements projections for 2 years with assumptions that tie to historical run rate, purchase orders, or executed contracts. You add a use of funds paragraph that links each dollar to revenue growth or cost reduction, which improves the probability of full or partial approval. Footnote. This section explains how a credible plan and projections convert narrative into measurable repayment. Reapply strategically. You wait the required window where one exists, such as 90 days for certain programs, and you reapply only after the cited weaknesses are cured. You attach a cover letter that lists each denial reason and the evidence of remediation. You accept that a partial approval or smaller initial limit can be a bridge to a larger facility after 6 on-time payments. Footnote. This section instructs you to time and document the reapplication so the new decision reflects corrected facts. Use alternative and online lenders prudently. You consider non-bank and online options when speed or flexibility is decisive, understanding that pricing may be higher and limits smaller. You compare total cost, remittance method, prepayment terms, and the effect on daily cash. You prefer structures that amortize and report positively to business credit rather than products that trap you in short-term renewals. Footnote. This section guides you to treat alternative credit as a tool, not a trap, by optimizing structure and cost. Conclusion and action checklist. You convert denial into approval by following a disciplined sequence. You assert your notice rights, correct data, improve leverage and coverage ratios, align with eligibility, evidence cash flow, operate through a business account, address industry risk, supply a plan with projections, and reapply with a cured file. Persistence paired with documentation is the method that moves you from no to yes. Footnote. This section condenses the playbook into a repeatable checklist that you can execute and verify.